First, I want to announce this is our last speaker of the Symposium series for this semester. However, the Thursday after Thanksgiving, December 1st, I'm told there will be an administrative meeting in this room at the same time at 5:15 for those of you who attend that sort of thing. I want to introduce George Schaefer today. George is currently an angel investor in Austin, but in his former job, he was a chief financial officer for NRG, one of our biggest independent power companies in the world, actually. And NRG is a very interesting story, as all of us know, and I think it's encapsulated in the title of his presentation, From Dust to Dust. NRG went through a dramatic business model change, a change that many of us, including myself, thought was the way to go in the future in the transition from fossil fuels to renewable energy and other sources of distributed energy and such. Didn't quite work out that way for David Crane, the CEO. And George went through those times and can give us some firsthand experience of what took place and why. George?
Thank you. Thank you, Roger. So just a little refinement on that. I was with NRG at the beginning of this period. I left in I was there from 2003 to about 2006. Was chief financial officer through their bankruptcy, which we'll talk about a little bit, and treasurer during its initial growth phase. But then moved on to do a startup in Dallas in the green energy space for the next 10 years. So but I stayed in close touch. In fact, several of the executives there are guys I hired. So, and I'm still a shareholder, so I know them pretty well. So my hypothesis here, which I'm going to try to explain, is that NRG, David Crane's vision as to what he wanted the company to become, and national energy policy as articulated by a bunch of the acts that we saw passed in the 90s to the 2000 current, were pretty much the same. Move us away from fossil fuels, move us towards green energy, move us towards a cleaner future. And unfortunately for David and for the company and for shareholders, it didn't work out. And the reason I say dust to dust is, I'll tell you the punchline now, but I'll prove it to you, is that if you look at NRG's stock and market valuation on the day on which it emerged from bankruptcy in 2003, and you look at the market value of the company today, and the stock value today, and you adjust it for stock splits and dividends and all that sort of stuff, he didn't even make a rate of return equal to inflation. He destroyed shareholder value. And that's a sad state for anybody to be in. I'll explain that to you in more detail, and since this is not as much a finance class as some of you have any questions about what I'm talking about when it comes to finance, feel free to stop me and ask me, and I'll stop along the way and see if there are any questions. So let's set the stage. The stage is, this is the United States energy consumption 2015, I think it is. And NRG is an electric utility company, an independent electric utility company that operates in this quadrant. About 40% of our U.S. energy consumption is in the energy space. So we're not talking about oil and gas. We're not talking about industrial-driven sorts of things or residential, although they do serve residential. From an electricity perspective, this is where they are. So they are an electric utility company. They generate their electricity from natural gas, coal, nuclear, a little bit of wind and solar. So if you were to basically cut this pie chart in half, they operate in the bottom half of this pie chart. That's the source of energy that they have. When it came out of bankruptcy in 2003, the portfolio was about 4 gigawatts, 5 gigawatts of power. Today it's 47,000. or 47 gigawatts, 47,000 megawatts. So tremendous growth over a decade and a half, 12 years. They started out mostly coal. They migrated to these other sectors with acquisitions and things that they did. So I want to roll back first, though, and again, because I've got too much history and I'm old and all that sort of stuff, and start with what some people may recall were the National Energy Acts of the late 1970s, when something was passed called PURPA, Public Utility Regulatory Policies Act, which allowed independent companies to generate electricity and sell it to the utility at what was then called avoided cost, or their marginal cost of electricity. Up until 1978, nobody could do that. If you wanted to generate electricity, you could consume it in your industrial application, but you could not sell it to a utility, you could not sell it to a third party. We had what were called in the United States, and still are called, vertically integrated utilities that generated power, distributed power, sold the power, fixed the power lines, and did all that sort of stuff. And what PURPA did was set the framework for entrepreneurs to come into the market and to begin to sell electricity to utilities at avoided cost. And it was a gold mine. I got to tell you, I financed under this rule in this period of time, 86 to 87, as states were implementing deregulations. We financed power, as a GE Capital, we financed power plants in California, Texas, Virginia, North Carolina, Florida, Maine, Massachusetts. I mean, it goes on and it goes on, Michigan. It goes on and it goes on. As states deregulated their electric utility and gas utility systems. But that also led to a problem. I'm going to go forward and then I'm going to come back to this. The problem was, not everybody did it the same. The map shows basically the brown space, none of these utility companies were deregulated. The blue space, the light blue space is natural gas deregulation, and some, like in California, some electric deregulation. Some, like Texas and Oregon, had full deregulation. Ironically enough, and the reason this happened was there was a small company down here called Enron. I don't know if anybody ever heard of that. Okay. And they also own Portland Electric up here. And so, ironically, those two look the same. So in the period between 80 and 86, 87, states were implementing this PURPA. Things were going forward slowly. And companies were building power plants under this regulation in these states that had deregulation. In 89, we started what I call the second wave of renewable energy awareness in the United States. There was, back in the 70s, some. I worked on biomass plants and wind energy, believe it or not, in the mid-1970s. And we used to call it gasohol there. I don't think anybody's old enough to remember that term in here. Well, maybe a couple of you guys are. But anyway, so it was called gasohol. And that failed when energy prices kind of took their collapse in the early 80s. But it came back in the late 80s. And in 80, 90, 92, this whole period, 10 years, was just a lot of setting the stage. Not a lot of progress, but a lot of setting the stage for renewable energy. The production tax credits. Every wind project today is a big user of PTCs, production tax credits. It's now at 2.3 cents per kilowatt hour. It started, I think, at about 1.4. And the wind industry would not exist if we were not for the production tax credit. In fact, it has been such a contentious issue that Congress, I'm going the wrong direction, excuse me here. Congress has had to work on protecting this tax credit almost every other year since it was first passed. So these acts set the stage. Some of them, for example, this one allowed the sizing of power plants to increase and sell power to utility companies. This act was focused on the rural market and allowed farmers to set up renewable energy projects and get tax credits. So we went through a 10-year, 15-year cycle of the government setting the stage for companies to become active in this marketplace. So some of the first movers, as I said a moment ago, into the space were independent power companies. There was one small company, Power Systems Engineering, which later became Destech in Houston. There was a company called Solar Energy Initiatives out in California. AES, which is now a big company, I remember doing their first financing in 1983, in the Houston Ship Channel. Another company called Cogentrix was organized in North Carolina. A lot of independent entrepreneurs, not utility companies, but people who saw the opportunity to build independent, we use the word non-regulated, I call it quasi-regulated, because if you're in the electric industry, you're always regulated in some form or fashion, but we like to call it non-regulated utilities. So these were all being formed, and after about a decade of success, the utility companies woke up and said, geez, we're losing market share to these people. We're selling less electricity because these people are generating electricity. In fact, we're buying electricity from people at costs that are above our average cost. Why are we doing this, and what's our business model for the future? How are we going to look if we don't build any new generation? Yes, sir.
What is the basic reason that the vertical utilities were being priced out of generation? Are they just terribly inefficient at their job?
So I wouldn't say that they were priced out as much as their vision was different. Utilities think in big chunks, 500 megawatts, 1,000 megawatts, big chunks of power blocks. And these entrepreneurs thought of in 50 megawatt chunks and 100 megawatt chunks. So they were much more agile, and they could be much more, they cost less to build. They could put them in places that had constraints that, you couldn't put 500 megawatts in West Texas at that time because the power line couldn't bring it east, but you could put 100 megawatts out there. So it had to do with the sizing and kind of the philosophy. Remember this, up until 79, nuclear was a big part. We were building 1,000 megawatt nuclear plants. So it was a vision of generation. Does that answer your question?
Yeah, we're often led to believe that scale is good, but sometimes it's just not, right?
For 75 years, that was clearly the case in the utility business. But when this rule came in, and part of it was artificial. When the first act came in 78, they said you can't build an independent power plant bigger than 80 megawatts. It was kind of the utilities were like a little worried about who was going to be their competition. You could build a cogeneration project that was larger than that because it produced steam as well as electricity, so you could build a 300 megawatt power plant on a cogeneration basis. But if you're going to build a biomass plant or wind plant or a hydroelectric plant, you couldn't build it more than 80 megawatts. So that was kind of the political compromise. And that wasn't done until I think about 2002.
But these initial efforts
But
were...
they didn't have to be economic. Remember what I said a moment ago. These plants initially were able to sell their electricity at marginal cost of electricity, not average cost of electricity. So if you looked at a utility's distribution curve, and let's just say that at the peak hour at 6 o'clock in the evening, it was selling its cost of electricity was 8 cents. If I was a perper machine, as we used to call them, 24 hours a day, I sold to them at 8 cents. I didn't have to be efficient. Okay? It was again a political compromise, but it allowed us to basically, we signed a 10-year contract with PSEG or with SoCal Edison and they had to buy the power at the highest marginal cost of power in that period. That covers a lot of sins. So that ultimately was done away with. When we went to the Wholesale Power Act, this is, I don't know why I don't have it, but right around this period of time, they basically did away with that policy because the utilities are saying that's crazy. So let me move on here. Where am I? Other than I'm in Austin. So NRG comes around. Northern States Power, utility company based in Minneapolis, says, oh, well, geez, all these companies are organizing unregulated subsidiaries. In 1994, Houston, the then company called Houston Lighting and Power, establishes its subsidiary called Houston Energy International. In 1990, Southern California Edison organizes its subsidiary called Mission Energy. Southern Power sets up its. So in the early 90s, the utility companies say, we've given up too much market share, all these guys are running around, blah, 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 we're going to set up our own subsidiaries. And they did a mixture of people being transferred from their business to people being hired from the outside. When I was hired to be a CFO of the international group, well, it was a domestic and international group originally, in 1995 over at Reliant Energy. I was the first outside hire. Everybody else was an internal transfer for the first 18 months or 2 years. So this was going on, and everybody would say, well, I got to get big, I got to get moving, I got to start doing stuff. I've got already got these established competitors. I got this wacko company over in Houston called Enron buying things up and doing stuff and all that sort of stuff. And so we have this, in the late 90s, NRG and all the other competitors are in a land rush. They're trying to find places to build plants. They're trying to buy other people's assets. They're looking at buying up companies that already exist. For example, DesTech, which was an engineering company, bought another engineering company, which was Power System Engineering, and then they got acquired by somebody else and ultimately became part of the asset base of Dynegy, which is over in Houston. So there's a lot of acquisition going on, and what do you need to do acquisitions and development and all that sort of stuff? You need money. And so Northern States Power and the other companies start to issue balance sheet debt on their balance sheet to raise money to finance the growth of their businesses. And it goes on like crazy. And at the same time, there's just incredible changes going on in terms of the regulation and in terms of pricing of electricity. And frankly, this is when Enron starts to show up in the picture and market forces become weird. I remember being beaten up by my boss saying, I don't understand, you're the CFO, how come Enron is showing this sort of return or this sort of asset or showing this sort of thing and we can't do that? And I said, you know, Lee, I don't know. Well, find out how come. You know, hire Ernst & Young and blah, blah, blah. We'd tear through the balance sheet and we'd look at their economics and I go like, I don't have a clue. And I remember being told once, well, maybe you're not smart enough. All right, I didn't go to jail. Anyway, so back to the NRG story. So they're doing this, and like all companies that finance on balance sheet, you have a limit as to how much you can do. You know, the rating agencies look at your debt, the stock market looks at your capitalization ratios, you got cash flow that you got to pay your debt with, you know, are your assets generating enough cash flow? And they realize that maybe the way to go, or they think maybe the way to go around 2000, is to issue public stock for 19.9% of the company. Now, why did they do that? Two reasons. Number one, it gave them public stock, so they raised about $800 million that they could then spend by issuing the public stock. If you sell to the public under accounting rules less than 20%, you can keep that asset, that company, on your balance sheet. You don't have to. So your accounting is stronger from some perspectives. And so they raised this debt. They raised this equity, excuse me. They then went out and raised some more debt on the subsidiary. and they were buying up stuff left, right, and center. And they got into a couple of contracts with Enron that were long-term contracts, and they were just like off to the races, they thought. And then around 2000, the end of 2001, Enron, there's market disruption going on. People are looking long at Enron. I was at Enron from the summer of 2000 to January 2001, and left. I was 50 years old. I saw a lot of stuff going on I didn't like, and I quit. You know, father, 2 kids in private school, mortgage, all that sort of stuff. Did the smart thing and quit. Anyway, and so there was a lot of crisis going on, and all of a sudden NRG is finding that it can't get the cash flow that it was expecting from its power plants. Some prices are going down. There's some pricing issues going on, whether it's legitimate or not, and this market disruption happens, and then NRG stock crashes. NRG stock was traded on the New York Stock Exchange at the time. NRG, they bought it back, pissed off, excuse my French, a lot of people because they sold it and bought it down here, right? A market crash, hey, we'll buy it back cheap. You know, sell high, buy low. And they consolidated back on their balance sheet. And then all of a sudden in 2002, they don't know what's going on. And the board fires the whole management team and brings in a bunch of crazy people like me to figure out what to do with the company. And at this point in time, I was working someplace. And my motto is I could never keep a job, but I could always find a new one. I had 22 jobs over the course of my career. Okay, I lived a millennial lifestyle as a baby boomer. Moved 8 times. My daughter still just hated it when I left Texas. Then now we're all back in Texas. So anyway, so we come in the late 2002, and we look at this company and we go like, whoa. It was scary. I mean, I walked in as CFO. I said, well, show me a list of all the debts that you have and what your obligations are and payment schedules and all this stuff. And they go like, what do you mean? I go like, well, you know, your debt schedule, right? We owe Bank A this much, Bank B that. We don't have that. What do you mean you don't have that? Well, you know, well, how do you know when your payments are due? Well, we get a bill. The bank calls us up, sends us a bill, and we pay the bill. I go like, really? You don't know what your debt obligations are? How much cash you need next quarter to pay your... It was a train wreck. I guess that's why we went into bankruptcy in December of 2003, April of 2003, excuse me?
Said it worked for Donald Trump?
Yeah, right. Well, look, it's a legal process. It's the way in which companies, it's an amazing U.S. process. It doesn't exist in Europe. And they have a different system, but the whole idea of the system here in the United States is to protect the estate. And over there, it's to protect the debtors, and it works completely different. And a lot of companies like NRG arise from the dust. When we did this exit financing, we did the exit financing in 2003, the investment bankers put together, a phoenix rising from the ashes. And that's what we thought we were. So anyway, I'm rambling a little bit. Excuse me. Am I okay on time? 5:40. What do we got till 6:15? More or less. I'll pick it up a little bit. So NRG comes out of bankruptcy. We have a market cap of about $2.5 billion. We issue about 2.7, about a $5 billion balance sheet. That's a big company. We'll get ourselves listed on the New York Stock Exchange. One of the highlights of my career was to be up on the big board with John Thane ringing the opening bell on March 4th, 2004. It's really something you got to do once in your life if you're a finance guy. By the way, I never studied finance. True story. I was a political science, public administration student. Never took an accounting, business, or finance course in my life. My dad always said, I don't understand how you got this job. I go like, I don't know either. Anyway, so we came out, we chugged along, we grew by 10% the first year. This is a market capitalization, it's 2.4 the year before. So we're doing okay, for the first year of bankruptcy. We refinanced the business. When you come out of bankruptcy, the banks have got you under chains, the handcuffs, and you open it up. And in 2004, David Crane joins the company. So everything now that I've talked about is pre-David Crane. Now we're going to talk about David Crane. David Crane was a visionary. David Crane took an old company that was coal-based in the Northeast. If we go back to this map for a second, all of New York, Pennsylvania, we had a couple of assets down here. Believe it or not, we had no assets there. And we had an asset in Illinois, an asset in Michigan. But we were basically a Northeast-centric, because of this, this is where all the deregulation has happened, a Northeast company. We had an asset or two out in California, a small thing. And he says, well, we're going to Texas, we're going to other states, we're doing, and so what happens is he comes in, and the first thing we do that's big after we kind of come out of bankruptcy is we acquire a Texas Generation Company, Texas Genco, which was an old Reliant Energy company. I didn't say here, but back in 1989, 88, Texas deregulation happened in a big way, and Reliant Energy was broken up into three companies. CenterPoint Energy, which was their poles and wire company, Texas Genco, which was a generation company, and Reliant Energy retail operation, which sells the electricity. And ironically enough, two of those three companies are now owned by by NRG Energy. So much for breaking up the utility. So we acquired Texas Genco. We had about a $5 billion company. They were a $5 billion company. We did about a $10.5 billion recapitalization of the company in 6 months. Everything from equity in the stock market all the way up to structured debt. It was a lot of fun, I got to tell you. Never want to do it again, but it was a lot of fun when it happened. Then he says, okay, now we're a big company. We got some policy going on here. Remember we talked about some of the energy policy earlier? I think I mentioned there were loan guarantee programs and there were R&D programs for nuclear and things of that nature. And he says, you know what? I think we've got this nuclear plant that we acquired from Texas Genco, the South Texas Nuclear, which is owned by three partners, Austin Electric, CPS, which is the utility company in San Antonio, and NRG. Originally Reliant Energy. Originally it was the three utility companies in Texas. NRG was the major owner. CPS was the second, and I think you guys had like 5% or something of that nature. 16. And so they originally applied for their application. It was a $10 billion plant. CPS was not part of the original work. I know they tried to put the arm on both the partners. CPS comes into the expansion. The price goes from $10 billion to $13 billion to $17 billion. And CPS says, whoa, we're not there anymore. And NRG tries to, Steve Wynn, that's the name of the guy I was trying to think of. Steve Wynn is the executive running this business for David Crane. David Crane is out there, saying, the new way to go in dealing with the carbon issue that was becoming an issue, global warming, was to do nuclear and all that sort of stuff. And then, of course, what happens? Fukushima, thank you. And they sold a 10% share to Tokyo Electric as well. And guess what happens? Like the next month, they say, we can't do that. David writes off $330 million off his balance sheet for the failure of the nuclear project. Now, I don't care how big a company you are. $330 million starts to become real money. And he looks around, and David is always pushing the envelope. David wants to be a visionary. David wants to be somebody who is different, and wants to be a game changer. And we need people to take those positions. That's how progress is made, right? If somebody doesn't want to do something different than what's been done for the last 5 or 10 or 20 years, nothing will change. So, You know, David's pushing, and the stock market, I'll show you the stock price here in a second, or I'll get to it right now. The stock market is rewarding David very nicely. This is a timeline from 2003 to 2016. I'm sorry I don't have all the things. But, I mean, his stock is doing pretty well relative to the S&P. But he says, well, I got to do something different. So 2011, he abandons nuclear, and he says, I'm going to become the largest wholesale generator in the United States, and I'm going to become a major green power producer in the United States. Those were his visions. And if you read what he says, his focus is, let me go find this here in 2007. His themes of his annual report, 2009, I'm sorry, are wind, CO2 reduction, nuclear power, eco-NRG, which is basically energy consumption reduction, and repowering of his coal plants, in addition to putting coal, carbon, and capture and things of that nature on it. So everything that's going on in the public policy arena is being pushed to a certain degree by David and encouraged by his board, and everybody's chugging along, and it's doing fine. And in 2009, his initiative right around here, that back in this period, is to become the leading green producer in the United States. And he actually becomes, I think it's the next year, 2011, the largest green power retailer in New York, which is pretty interesting. And was signed a contract to provide 100% renewable energy to the Empire State Building. What more iconic image can you have if you want to become a green operator than to have the New York State Building lit up in green and say, I did that, right? This is the image. Excuse me?
Was that through Green Mountain?
Yes. Yeah, exactly. Through Green Mountain Energy, which he acquired in 2010. I want to say he acquired Green Mountain Energy. Yeah, 2010. And so this is his push. He's pushing wind. He's pushing, this is using the wind production tax credit. He's pursuing, he's abandoned nuclear. He's looking at solar. He buys into the Ivan Path thing in California. I don't know if that is. That's where the steam tower up on the 500-foot column with all the mirrors that are, And interesting enough, again, talk about history repeating myself. I remember in the late 1970s looking at a project like that was under construction in New Mexico at the Sandia National Lab. So these ideas are always there and coming around and things of that nature. So now he's pursuing this growth, and but he's starting to run out of cash. And the market is not being kind to him. His market capitalization is still strong, but his price is coming down, so he doesn't want to issue stock. So what he does is he says, this is financial engineering, done by one of the guys I hired, actually, a guy named Chris Sotos. He says, we're going to do what the real estate industry does and what other industries do. We're going to take our cash-producing assets, our coal plants, we're going to spin them off into a new company. We're going to call it NRG Yield, but it's really a REIT, Real Estate Investment Trust type structure. We're going to put all the assets in there. We're going to generate cash. We're going to sell it to the stock market. We're going to take that cash, bring it back into the company, and we're going to use that money for our growth initiatives. Great idea. Market loved it. It was considered a groundbreaking deal when it was done in July of 2013. It was announced in 2012. It got copied by many, many other companies. He raised, I want to say about $850 million, big number, and off to the races. But the premise of NRG Yield, unlike some REITs and other things, was that it had to keep growing. People don't buy stocks to just get a 5% yield. They want the yield to go up to 5%, to 6%, to 7%. In order to do that, the NRG company had to keep developing projects and then selling those projects to NRG Yield, getting the cash back to reinvest in new growth, and NRG's portfolio would grow to continue to provide growth to its investors to meet their yield expectations. And he fails to do that. Why did he fail to do that? Well, we all make projections. And he's looking at new technologies for them, not necessarily dynamic technologies, but like you said, wind, solar. He buys a wind company, doesn't like what they're doing, sells it, buys another wind company, doesn't like what they're doing, fires the CEO, puts in one of his guys, right? He buys into some wind projects. They run into development projects, construction projects. They're delayed. And, it's a story that we all know. It's execution against an expectation that sometimes works and sometimes, many times, doesn't. This is the problem with any sort of development that one would do, whether it be in the energy industry or in the IT industry or in the software industry or, as many of you know, I'm invested in startups here. I've got a portfolio of startups I invested in, and one of them was just an absolutely brilliant idea, and then the market changed, and now we're doing what's euphemistically called a pivot, which means the first idea failed. Let's figure out what the hell to do before we run out of money. Okay, so this happens, but it happened in a big way to David. $1 billion worth of big. That's $1 billion with a B between 2013 and 2015. And his stock yield crashes and NRG crashes. In 2015, the market capitalization of the company, NRG, falls to $3.5 billion. Where was it in 2004 when we came out of bankruptcy? $3.3 billion. 12 years of work, planning, growth, raising money, buying companies, doing what everybody thought was the right thing, myself included. Going along with national policy, the loan guarantee programs for solar, the loan guarantee program for nuclear, the PTC for wind. And at the end of the day, the shareholder, yes, Mitch?
George, two questions. How much did you pay for Green Mountain?
I have it written down in my notes. I want to say it was $550 million.
And
Yep, I'm sorry, $350 million.
of course, that's an Austin-based company. We all were pretty close to Green Mountain. A lot of people left.
Yeah.
There's been a lot of turnover. What would you say Green Mountain is now as part of NRG? Is anybody here from our NRG or from Green Mountain? No?
Don't know the answer to that question.
Okay. Second question. During this time, I think it was 2010, 2011, there was a fund that was built. There's a $300 million fund. $100 million was put in by ConocoPhillips, $100 million was put in by NRG, and $100 million was put in by GE.
Right.
Were you a part of that?
No, that was led by Clint, who was another guy I hired. I had left by that point in time. They could never find any projects that they could all agree on. Clint is now the CFO over at Dynegy. And Bob Flexen, who was my boss for a while, is also over at Dynegy. But the three of them, and of course I worked at GE Capital, so I knew those guys too. They could never agree on a risk profile. They got one or two small things done, and they lost interest. But they never, at least there they didn't spend the money because they couldn't figure out how to spend it. So, it was another opportunity that slipped through their fingers, but at least it didn't cost them $1 billion. So to just wrap this show up, and then I'll leave more time for some questions. So my thesis, unfortunately, and this is why I say dust to dust, is NRG starts, and this is all risk, again, adjusted because the actual prices were different. Started at $10 in 2003. That's the day we came into bankruptcy. Today, if you put $10,000 in, it was a $10 stock, it'd be worth $12,000. Actually, it's a little less than that. Today, it closed at $11.20. If you put it in the S&P, you'd have twice that amount of money. And if you'd just gotten inflation, you'd have more than that money. Inflation has been around, I checked the other day, it's been around 18%. So, unfortunately, you can do all the right things. I don't think David did anything wrong. I don't think the company made a bad decision, looked at something and said, well, this doesn't make any sense, but we're going to do it anyway. But there are a couple of lessons that I take away from this. One is David's board. David's board was organized in 2003. John Chawatsky was the board chairman, and he is still today. Ann Schomburg was put on the board, and she's still on the board today. And the board composition has basically, with I think out of the 9 members, 3 have changed or 4 have changed. But the core decision makers at that company are still the same, and they're all guys who were hired by David or the people at the end of bankruptcy. And they all have, to a certain extent, groupthink. The other thing is groupthink. I can tell you from personal experience that, when the emperor says we're marching in this direction, there aren't many guys who say, wait a minute, David, you think you got that idea? You got it wrong. I mean, I once made that mistake. And I got, so when the boss says I want to grow, the boss says I want to look for new opportunities, the boss says I want to become a green energy company, everybody gets on board and not many people challenge him in a company like this. Maybe it happens in different companies, but there was no governor on the drive, right? Everything was go, go, go. And I think that's part of what happened here.
Thank you. George, question for you. Over that period of time, 2003 until like now,
Last week.
NRG built a lot of wind farms capacity and some substantial solar capacity,
Yep.
which is operating today.
Yep.
So roughly what, do you know off the top of your head what those numbers are in terms of megawatts or?
I know that they have a
Ballpark
gross
figure?
amount of 47,000 megawatts, 18 plants, 18 states, and over 100 plants, but I don't have that breakout for you in terms of, I should have had that, but I don't.
They clearly,
Like I said, they went from 4,500 to 47,000.
okay, well, a lot of that was combined cycle.
Right.
Even the wind and the solar portion of that was it was a substantial number.
It was in the thousands of megawatts.
So David Craig could look back on that with pride.
Well, without an argument. Yeah, if you want to forget financial results,
I mean, in terms of tangible assets.
in terms of hard assets, absolutely. And he pointed, but what's the point of building the plants if you don't make a return for your shareholders? That's the point of running a business. The stakeholders are the employees, the public that you serve, and your shareholders. Those are the stakeholders, right? And one could argue corporations, I would argue, that corporations are owned and run for primarily the benefit of their shareholders. Sir? Oh, okay. Wait, what? You're pointing at me? Oh,
Going back to Enron, and I want to ask about mark-to-market accounting.
Yes, sir.
I think that was a big problem. They were able to hide what they were doing because of mark-to-market.
Yeah.
I was just wondering, what's the status of it today? I know the Europeans still use it. What about American accounting?
I haven't stayed up on all the accounting rules, I must admit. But obviously when Dodd-Frank came in, there was a major change as to how to do that, that sort of accounting. But I apologize, I haven't paid attention to it for 5 years or more. So, huh?
You're fishing.
Not fishing, thanks. My friend over there.
Thanks. This is a great talk. I have sort of a maybe general question about the time period at which you showed after essentially you started your timeline at PURPA in 1978. And that was a time of basically perhaps the highest interest rates, and certainly the modern era, and interest rates roughly declined until the 2000s. And people were going gangbusters financing. How much should we view this time period in energy, or perhaps anything, as a one-off? That the types of refinancing and things that allowed these companies to succeed for a while could potentially just not continue forever once we got to zero interest rates, which occurred in the late 2000s here,
Well, yeah,
right?
zero interest rates started, I mean, they've been going on for a decade now, right? Look, I've always been a believer that you can find financing for good projects in good markets, bad markets, high risk cost markets, lower cost markets. If you have a sound business plan, you can generally find the money to do it. That's not to say that things don't happen and companies don't go bankrupt and people lose their money, but it's just a question of return to people and margins. But there's no doubt that the last decade, the asset bubble, if you want to believe what some people are saying, whether it be in the stock market or the real estate market, is driven by free money or low-cost money. But this growth was going on back here too, right? I mean, the land grab, as I think about it, for assets was going on in the late 90s, and interest rates were high single digits, So it has an effect. It makes less things attractive, but it doesn't stop anything. Unless the markets just freeze up completely. My viewpoint. As I say to my children, I'm never in doubt, but I'm often wrong. Any other questions? Sir?
I guess I have a question on like financing in general. So what they did with like moving their assets to NRG Yield and getting like raising money and then spending that money, I mean, a lot of like the bubbles and like when bad things happen in companies is when they like overfinance and they spend it. So I don't know, how do you as a CFO make the distinction between like you're going to raise $1 from here and you're going to spend it on this, but this is actually a good reason for raising money as compared to not a good reason.
Well, this gets back to your modeling and your assumptions and creating value for shareholders, right? You look at your balance sheet, you look at your assets, and you say, I could raise money, I have a weighted average cost of equity and a weighted average cost of debt, and a WACC of the company of 8 or 10%, and I'm going to invest it in this asset, and my assumptions work out. I think I can get a 20% return, but if my assumptions don't work out, I'm still going to get a 15% return, and if all goes to hell in a basket, I'll break even. And you run the models and you run sensitivities and you assume the cost goes up by 10% or the market doesn't develop or you get delayed by so many months or something like that, and and then you do triage on your projects. You take the ones that have got the highest return and you look at those really hard, and if they pass the requirement for you, you invest in them. You cannot stand still. You cannot make a decision just hold on to your cash, because then you're not going to grow your stock, you're not going to grow your assets, you're not going to become again, they'll talk about a public company. Private companies operate very differently. One of the interesting facts, I always, today there are fewer public companies in valuation than there are private companies. A lot of companies have been bought back. Most of the growth have been in private companies. A great example here is a company that I'm actually invested in called Funware. Funware is a very successful multi-screen service startup, but not a startup anymore. 700 people, been in business for 5 years. CFO, CEO have no interest in going public because they can run the company the way that they want and without having to deal with the public. So many CFOs don't have to deal with the public, and their decision-making is somewhat different than a public company. And if you're a startup, just go back to this world for a second that I'm in, startups got to think, I got to raise an angel round, I got to raise an A round, I got to raise a B round, I got to grow my assets, grow my company. Then what do? Do an M&A transaction, do an IPO. Those are the sorts of things. But you always got to keep moving forward. You can't stand still. You can't just sit on cash. And if you do sit on a lot of cash and you're a public company, you become a target, right? Does that answer your question?
I really appreciated your comment about the board kind of mired in stagnation and groupthink. I was curious if you think a lot of the growth on, for example, the ESG criteria and rating agencies that are happening now, would that kind of increased transparency or visibility have even mattered?
I'm going to read you a quote. David and I used to fight all the time about the rating agencies. All the time. Why can't I get my rating agent? the rating up, all that sort of stuff. So I'm going to read you this. This is 12 unforgettable quotes from NRG CEO David Crane, published about 18 months ago. And please, to the ladies in the room, please excuse me. I'm quoting. I'm not saying. I don't want any offense taken by any of you. After NRG emerged from bankruptcy, the company decided recovering its investment-grade credit wasn't important. That was true after bankruptcy. Quote, the prospect of any company in the merchant generation industry recovering investment-grade ratings is a delusion, and that's not the way we're going to operate our company, said David Crane at a Lehman Brothers conference. Well, there's an interesting juxtaposition. You can't go to the men's room without calling the rating agencies and asking them what it's going to do without affecting your credit rating. Okay, David, at that point in life, this was 2003, I don't have it up there, 2004 or 5, hated the rating agencies. And then when we went to acquire Texas Genco, he was like, God darn it, I got to get that triple B rating, George. Why don't you get it for me? I said, David, you haven't been telling me for 3 years you don't care. Now you care. I can't help you. Anyway, Arlene Specter, I still remember my rating lady. The rating agency, S&P was Arlene Specter, and it was Angelo Sabatelli at Moody's. I haven't talked to him for 10 years, but they're bad dreams. Actually, I like them both. You know, the rating agencies have always played kind of a funny game, right? You have to pay the rating agencies to do your evaluation. And the rating agencies know that if you don't pay them, they don't get revenue and they don't get money and lots of stuff. And so, you know, there was just sort of this game between the two of us, between like, well, I got to get my rating up. What do I need to do to get my rating up? You know, what do you want me to look like in 6 months? And then after I do that, I'll come back and will you give me an upgrade? And if you don't, well, maybe I won't engage you now. Maybe I'll go do something else. Kroll, in the last 4 or 5 years, has started its own rating agency. And the other guys were Fitch, right? And they're kind of third place, fourth place now. I mean, the rating agencies have always been there trying to moderate, to a certain degree, the activities of a company. But for the most part, people ignored them. Most part, you ignored them. Because you couldn't, although David said he couldn't go to the men's room, he did what he wanted to do, you know. All right.
So you talked about benefit to shareholders, and I want to focus more on the benefit to the consumer base. Mm-hmm. This was the go-go period. Everybody was building and buying, and arguably they were overbuilding. And then when you combine that with the low natural gas prices that come in, somebody had to fail.
Right.
But that delivered a benefit to the market in general, because now the prices are substantially lower than they would have been had you been anywhere near a production margin. So I would say, well, it's unfortunate that it was NRG, but they had collected assets that required a higher price for that yield company to keep functioning, and that wasn't there. So they just set themselves up, as circumstance would hold, to be the guy who failed.
So, but this is not unique to NRG or to these assets. It happened in Texas in the late 1990s. You know, these power plants, to this gentleman's discussion we had a moment ago, even the small power plants are big pieces of equipment, 500 megawatts. And demand kind of goes up at a relatively modest, what did we say, 7% a year or something of that nature? I don't think it's that high in Texas, but it's relatively small. But the power plants come up on the chunks. And when everybody sees a market opportunity, I used this term earlier, there's a land rush to try to build it. And so 4 or 5 guys rush in and try to build power plants, and they overbuild, and prices collapse. And the first restructuring I had to do was not for NRG. The first restructuring I had to do was for a company called Texas Independent Energy, which was based in Dallas. And they had built 2,000 megawatt power plants out in West Texas. And then when in 1999, somewhere around that, this was 2001, and and prices collapsed because they and other people had built too much capacity and they couldn't service their debt. And West LB owned the debt on 2,000 megawatts worth of power plants. It was billion-something dollars. I forget exactly what it was. And we had to restructure that debt. So, I mean, it's just the nature of the business of building big chunks. While everything's going on like this, everybody sees the opportunity. They run in, collapses, and then it gets rebuilt. Same thing happened in California. In these deregulated markets, that's the risk you take, but that's what's private enterprise, right? And you're right, the beneficiary is the consumer or the ratepayer who gets the benefit for a period of time. But unless you're going to give a return, a principal as well as, or fixed as well as operating costs, variable costs to the investor, the utility company, the IPP, whoever you want to call it, you're not going to get assets built. So you got to figure out a way to do that.
Do you see a sign, or is there a critical point where those assets won't be built? I mean, arguably, that's kind of what everybody's waiting for, is a sign that people will not build. And it's not obvious that that's on the horizon.
You know, I'm terrible at predicting that sort of future. I mean, we don't want that to happen, do we? We don't want people to stop building assets for power generation or whatever. I mean, right now, as I understand it, and maybe others in the room might get this, we're getting pretty close to a thin capacity margin here in Texas, right? So that should send a price signal somewhere in the not too distant future to start building more assets. And if it doesn't, we'll have rolling brownouts, and then the government will have its hair on fire, and, you know, somebody will step in and come up with the next idea. Oh, maybe we'll finance it with government money. I don't know. I can't answer that question. But I got to believe that if you believe in efficient markets that aren't messed up too much by regulation, you know, there should be market signals to build plants. It won't always be pretty, but there should be market signals.
I guess I can ask a question as well.
Yeah.
So it happened to be that I bought NRG's share when it was like $6 in February 2016.
Yeah.
And I bought it, and then I hold on till it went to $18 in June. Then Tesla's and SolarCity's earnings come out, and it goes crashing to like, I think like 14, 12, and it goes down.
Right.
And after the election, it again starts coming up. So what my question is, how much does it have to do with the lobby that was done, and also with lack of innovation in the green sector, like you see in SolarCity or like in First Solar, or not Sun Edison anymore, but so
Didn't they go bankrupt too?
Sun Edison got bankrupt, yeah. So I'm saying, was it not innovation enough? Was it lobbying at some point, which was like?
Look, the stock market is an expectations game, right? We're you know, if I knew how to pick stocks right, hey, I'm still holding on to my NRG options that I should have sold it when it was way up here. I mean, I got options priced down here, and I'm still holding them here. So don't ask me. I should have sold. You know, and I talked to one of my friends, Tim O'Brien. He says, "Well, George, I sold it like right about there at 35 on the way up." I said, "Well, Tim, I don't remember you calling me to tell me to sell." Look, the earnings report that came out in the spring didn't meet the expectations. They modified, as I recall, they modified their earnings forecast for next year, for 17, dropped it down, and people looked at that set of numbers and said, it ain't what it was. So we're going to back it down to from 14, I think it went from 14 to 12 or 11. Yeah. That ain't as bad as some of these other moves. But anyway, who knows? I mean, but they lowered their earnings forecast.
Okay, I guess when I want to sell, you can tell me when to sell.
Yeah. Don't even go there.
Should I hold on?
I'm not giving any advice. I should have sold in 2007. I like the stock. Yeah. There you go. The line was busy. Well, thank you for your time today. I hope that was helpful or interesting.
Thank you very
Yes, please, everybody.
Thank you for the talk.
Oh, pleasure, pleasure.
Michael Ball.